All right, let's talk about Crocs. Their latest earnings report, well, it's a bit of a head scratcher. They actually beat expectations, but the stock went down. So in this explainer, we're going to unpack exactly what Wall Street was looking at. We'll dig into the numbers, the strategy, and figure out what this all means for the company going forward.
So here it is, the central question of the day. Crocs comes out, delivers results that are better than Wall Street expected, and you'd think that's a good thing, right? Well, the stock still dropped 2.5%. So what on earth did investors see that made them hit the sell button? That's the mystery we're going to solve right now.
Okay, here's how we're going to break it all down. First, a quick Q3 snapshot. Then we get to the real drama, a tale of two brands. After that, we'll look at management's game plan, see what the market thought about it, and then I'll wrap it up with what I call the next call. All right, first up, the Q3 snapshot. And you got to understand the context here. Yeah, Crocs beat the estimates, but they were beating a lowered bar. The company's performance was actually down from last year. So this wasn't really a story about growth. It was more about them managing a slowdown better than people thought they would. And look, it wasn't just a small beat. It was a pretty big one. Adjusted earnings per share came in at $2.92, absolutely crushing the $2.37 analysts were looking for. And revenue? Nearly $1 billion, which was a good $35 million more than expected. So, on the surface, this looks fantastic, a clear win. But, and there's always a but, isn't there? The real story is hiding just beneath those shiny headline numbers. See, this quarter was basically a tale of two completely different brands. And one of them, well, it's acting like a giant anchor, dragging the whole company down. Let's get into it. So first, just to set the stage, let's look at where the money's coming from. The classic Crocs brand is still the big engine here, right? It's bringing in 84% of the revenue. And then there's HEYDUDE, that big brand they bought a few years ago. That's the other 16%. So yeah, Crocs is the giant, but 16% from HEYDUDE, that's definitely a meaningful chunk of the business. And right here, this is the whole problem, laid out in black and white. The main Crocs brand, it was down just a little bit, 2.5%, totally manageable. But then you look at HEYDUDE, down a whopping 21.6%. Oof. That is the anchor I was talking about. This is what spooked investors. That kind of weakness in one part of the business it was so bad it cast a huge shadow over everything else. Okay, so HEYDUDE is clearly struggling. And let's be honest, the economy isn't helping anyone. So what's management's plan? What are they going to do about it? Well, they're playing defense. Their entire game plan is all about two things: controlling costs and cleaning up the business. They're basically pulling four big levers here to try and get the ship sailing straight again. First, they're getting super aggressive on cutting costs and just being more efficient. Second, they're shifting more focus to selling directly to you, the consumer, because that's where the better profit margins are. And third, and this is a huge one for HEYDUDE, they're cleaning up their wholesale channels, basically getting rid of old inventory to kind of reset the brand. And when I say they're getting aggressive on costs, I mean it. They've pinpointed $150 million in gross savings. That's $50 million this year and another $100 million coming right after. That is a huge number, and it shows they're dead serious about protecting their profits while sales are looking a little shaky. And you don't have to take my word for it. Just listen to the CEO, Andrew Reese. He said on the call, "We're working to quickly right-size our cost base, to simplify the organization." I mean, that's about as clear as it gets. Right now, it's all about efficiency and protecting those profit margins. So, okay, management's got a plan. That's great, but what does the market think? To really get why the stock went down, you have to zoom out and look at the bigger picture. This negative reaction wasn't just about this one quarter. It's about a pattern that's been going on for a while. And wow, this chart really tells the story, doesn't it? Over the last year, the rest of the consumer discretionary sector, think of it as their peer group, is up over 20%. Crocs, it's down more than 25%. That is a massive gap. So again, this isn't just one bad quarter. The stock has been seriously lagging behind its peers. So here's the bottom line. The market basically ignored the good news from Q3 and looked straight ahead to the future. And what did they see? They saw a company guiding for an 8% drop in revenue for Q4, the all-important holiday quarter. That weak forecast was all investors needed to hear. It confirmed their biggest fear, that these problems, especially with HEYDUDE, aren't getting fixed anytime soon. All right, so after all that, where do we stand? Let's get to our final section, the next call. I'm going to lay out what I'll be watching for, and then give you my thesis and my official rating on the stock.
So moving forward, there are 4 main things you need to keep your eyes on. First and foremost, can they stop the bleeding at HEYDUDE? Second, will they actually deliver on that $150 million in cost savings? Third, can they hit their profit margin goals for Q4 even with sales going down? And finally, can they keep the growth going in their direct-to-consumer business? These are the boxes they have to check to win back the market's trust.
And this really boils down to the classic bull versus bear debate. The bulls will tell you that management's defensive plan, the strong cash flow, the stock buybacks, the cost cuts, is going to create a solid safety net for the stock price. But the bears, they're worried that the HEYDUDE problem is just too big to fix quickly and that a nervous consumer is just going to make things worse.
So after weighing both sides of the argument, my reading on Crocs is market perform. You can think of this as a neutral rating. It's kind of cautious, but still constructive. And here's why, in a nutshell. The aggressive cost cutting. That provides a really solid safety net. It should protect the stock from totally collapsing. But that brutal decline in the HEYDUDE brand, plus that really weak guidance for the next quarter, it just makes it impossible to be truly bullish right now. Plain and simple, we need to see proof that the HEYDUDE brand is stabilizing before we can get more positive on this stock. And of course, just as a final reminder, this is not financial advice. This analysis is for informational purposes only.